back. Let's talk about global investing with Ken McAtamney joining us from William Blair. Ken, let's try this again. Let's start with the stocks and the themes that you like in this recovery. Do we still have more to go around the world?
Yeah, Oliver, we do. Sorry about that. Travel and leisure really hasn't recovered at all. We're starting to see things resume in the U.S. and China. Europe is well behind that. We've talked to a lot of airlines this week, and May pricing is flat from 19. Yields are up. We really think that there's a lot of great pent-up demand, and people, when they feel safe and when they're allowed to, are going to take to the air and they're going to go on holiday.
So how do you play this? Is it just buying straight airlines? I mean, some of these companies, at least the ones domestically here in the U.S., have recovered fully from the pre-corona era. Not all of them, but the domestic-focused ones have. How does it look outside the U.S.?
It looks better, frankly, because in Europe, we feel economic activity is about 6 weeks behind the U.S., and people really haven't resumed their activity. So one company in particular, Ryanair, think of this as the great discount airline of Europe, similar to Southwest Airlines of the U.S., very geared to leisure travel here. They've got the low cost, low price advantage. They're growing their routes throughout Europe, and they really haven't even used the lever of pricing power yet. So this company has not recovered back to its previous highs, and we think it's quite a bit of upside from here.
So today we saw that Boeing's got some orders coming as well. Boeing's a stock that's still pretty far down below its pre-COVID levels. What are the risks that one takes on here? I mean, have we lost the COVID risk at this point? Is this back to just kind of cyclical normal risk in these stocks?
I don't know that the COVID risk is completely diminished here. We've seen variance in many markets. We've also seen the emerging markets really struggling with the fighting of the disease. But I think in the developed markets, that pent-up demand for travel is so strong, and with greater safety, we're gonna see really an unleashing of leisure activity this summer.
So how does this fit in, rather, when someone thinks about the overall portfolio? I mean, for equities in general, is this a time to be skewed heavily towards the cyclical still? Because there's been a lot of cracking in some of that faith over the last several weeks. I've noticed people talking a lot about dabbling into the tech trades and reaching into the growth pile of discounts to try and find something. Where do you stand on that dynamic?
I think that the market has certainly been focused on during the pandemic, it's been focused on companies with high visibility of earnings, maybe that they're digitally enabled or advantaged, and they've been able to press their strength. I think that is very much a long-term secular theme. Yet that being said, those companies in many cases maybe had too much of the good news discounted in the price, and thus you're seeing, with the expansion of the economy, you're seeing this rotation between these classic great growth companies creating long-term value and maybe more depressed cyclical companies that will benefit from stronger economic activity, where we frankly tilting a little bit toward those cyclicals, as I mentioned. But as you can see, we've got a big focus on structural growth companies that, regardless of the economic outcome, will be leaders in their respective fields. And those companies form the core of what we do.
Now, when you look at the expectations, that kind of relative growth globally versus the U.S., any idea what that's going to look like? Do you have to have a compelling house view of ex-U.S. outperformance, whether it's GDP or manufacturing, reflation measures? What's kind of the most compelling case that there's more left outside of home?
Well, I think, what we've seen in China, which was first into the pandemic and first out, is a resumption of much of the economic activity there. So we can point to that first. That market has actually not fully recovered despite a stronger economy. So I think everything in the China ecosystem is interesting to us. Second is the U.S. has started to really unlock, and we're seeing that by all kinds of economic data, whether it's consumer or industrial. Third, though, again, I'll point out is Europe, which the Eurozone, as big as the U.S., really has been lagging in terms of their economic activity, and the stock market there has lagged as well. So if you think about the catch-up that we might experience in Europe, I think that's pretty compelling.
So, Ken, looking at the potential for this kind of shift to happen? Do we need to have like a big dollar breakdown? Do we need to see another leg lower for money flows to find their way outside the U.S.? Is that a big part of this? The currency trade is kind of opening the door?
I think that's only a small and secondary part of it. I think what this is really about is a gap between the growth. U.S. has led and been much stronger than many developed markets, including Europe. We think that that's going to be narrowing as we move forward, and the valuation disparity too is quite big as well. So I think the market will ultimately recognize that, and these things become pretty efficient through time.
Okay, Ken, really interesting thoughts and a great conversation. Looking forward to more. Thank you.
Thanks for your time.
Thank you. Ken joins us from William & Blair. When we come back, let's talk some options.